Welcome back to the Deep Dive. Today, we are getting into the Q3 2025 earnings call for RPID Micro Biosystems, that's ticker RPID.
Right. And this one was interesting because the results were released pre-market on November 7th. And the market reaction was pretty immediate and very positive.
Yeah, the stock moved significantly, and it seems like investors were looking past the headline numbers and really focusing on the strategic execution.
Exactly. It's all about this pivot they're making.
So our mission today is to cut through that complexity, look at the numbers, but really understand the big catalyst here. We're talking about the recurring revenue and a record-breaking customer order that seems to have changed the whole story.
Absolutely. But before we get to the exciting stuff, we have to start with the foundational results. They set the stage for everything else.
Okay, so let's do a quick snapshot of Q3 financials. Total revenue landed between $7.8 and $7.84 million.
Which is about a 3% year-over-year increase. And it just nudged past the Wall Street consensus of $7.6 million.
So small beat. But management was quick to point out something else.
Yeah, they were. This was their 12th consecutive quarter of meeting or beating their own internal guidance.
And in this sector, that kind of consistency builds a lot of credibility.
It absolutely does. Investors reward predictability.
Okay, moving down the income statement, the loss per share, GAAP and non-GAAP, came in at negative $0.26.
Right on the money. It was exactly what analysts expected, and flat compared to last year. So no surprises there. The company's still in its growth and investment phase.
And the net loss for the quarter was about $11.5 million. But the cash position is what I want to talk about. How are they managing their runway?
Well, they ended the quarter with roughly $42 million in cash and equivalents. But the really critical metric, I think, is the cash burn.
It's slowing down, right?
It is, and significantly. Net cash used in operations for the first 9 months of the year dropped to $27.8 million. Last year, for the same period, it was over $34 million.
That's a huge improvement in efficiency. It's the whole ball game. Reducing that burn gives them the strategic breathing room they need to execute on these bigger long-term plays. It lets them focus on what really matters.
And what really matters, it seems, is the revenue mix. Let's cross that bridge.
This is the core of the story now. Recurring revenue, so think consumables and service contracts, it just surged.
What were the numbers?
It grew 32% year over year to $4.8 million. And here's the kicker. That recurring stream is now about 62% of their total sales.
62%? I mean, that's a fundamental shift. They're not just a hardware vendor anymore. Is that what the market is reacting to?
It has to be. And if you dig into that 62%, the real gem is the consumables number.
Because that tells you if the machines are actually being used.
Exactly. It's the proof of utilization. Consumables revenue was up approximately 40% year over year, a quarterly record.
A 40% growth in consumables tells you these systems aren't just sitting in a corner. They are embedded in the customer's daily workflow, in their GMP, their good manufacturing practice. Right. Now, what's interesting is that while consumption is spiking, the pace of new system placements did slow down a little this quarter.
How many did they place?
5 new systems, with 4 customer validations completed. That's down from 7 a year ago. But management was really careful to frame this as in line with plan.
Suggesting a focus on quality over quantity.
I think so. They seem to be targeting these larger, more strategic rollouts that will generate more recurring revenue down the line, instead of just chasing placement numbers quarter to quarter.
And all this is starting to help margins, even if it's from a low base.
Correct. Q3 gross margin was 9%. I know, still a low number, but it's a 70 basis point improvement over last year. It's moving in the right direction.
And that, combined with the cost discipline, is driving that efficiency we talked about.
It is. Total operating expenses were down 5% to $12.1 million. They're trimming costs across the board: G&A, R&D, sales, and marketing.
Okay, I have to ask, though, how do you keep cutting costs when you've just landed a massive global order that's going to require a ton of support to deploy?
That is the million-dollar question, and it's a key risk. But management seems to think they can lean on their partners for scale. And they gave some very positive forward-looking guidance on margins.
What did they say?
They expect to hit positive product margins for the first time ever in Q4.
Wow.
Yeah. If they hit that, it's a major inflection point. It proves the model is starting to scale economically.
Okay, that's a huge milestone. But the real electricity in this call came from something that didn't even happen in Q3. It was an October announcement. Let's talk about that record order.
This was the catalyst. This is what drove the stock. In October, they locked in their largest multi-system order ever, And it's from an existing customer, a top 20 global biopharma company.
So what makes this so different from just, another big sale?
It's the scope. This is a double-digit system order for global standardization. We're talking automating their entire microbial quality control process across sites in North America, Europe, and Asia.
So this isn't a pilot program. This is a full-scale, enterprise-wide adoption.
Precisely. They're using all the applications to environmental monitoring, water, bioburden. This is a huge stamp of approval on the entire platform.
A huge validation. So when does this start hitting the income statement?
The system revenue starts flowing pretty much immediately in Q4 and will continue into the first half of 2026. But the real prize, that high-margin consumable revenue, that's not going to start ramping up until the second half of 2026.
After all the systems are installed and validated.
Exactly. There's a lag. And to pull off a global deployment like this, you need a rock-solid balance sheet.
Which is why they highlighted their liquidity, right?
Right. They pointed to the $45 million term loan they secured back in August. They've drawn $20 million of it so far. And it gives them the runway they need to execute this without, having to worry about their cash position.
And they're not going it alone. They lean heavily on their partnership with MilliporeSigma.
Yeah, that relationship is just critical. It's a dual lever. First, you get the global distribution. It extends their reach into markets they couldn't get to on their own.
And the second lever is on the cost side, if I remember correctly.
You do. It's a supply collaboration. Basically, they get to piggyback on Merck's massive global purchasing power. This is expected to bring their input costs for consumables way down, starting in the second half of 2026.
So that's the path to better margins.
That's the defined path. It's not speculative. It's baked into their strategy.
So you've got a huge demand signal from the record order and a clear path to margin expansion from a partner deal. This is starting to look like a really cohesive story.
It is, and it's all happening against a backdrop of some serious market tailwinds. This rapid microbiology niche is about a $1.3 billion market, and it's growing in the high teens annually.
And what's driving that growth so fast?
Two things,
Yeah.
mainly. First, the rise of biologics and cell and gene therapies. These are complex drugs with short shelf lives. You can't wait a win for traditional microtesting. You need answers now.
And second,
Regulatory pressure. Regulators all over the world are pushing for faster, more reliable, and more automated safety testing.
which all ties into why they felt confident enough to raise their full-year guidance.
Exactly. They hiked their 2025 revenue guidance to at least $33 million. That's up from their old low $30 range. And it's all based on placing at least 27 systems this year. The market loved it.
So given all this positive momentum, what's the primary risk that you still see? Where could this go wrong?
It really just comes down to execution. A global deployment of this size is incredibly complex. Any delays in installation or validation could push out that high-margin consumable revenue. They have to nail it. And they have to prove they can keep expanding margins from this very low base.
The story's great. Now they have to deliver.
That's it.
Okay, that brings us to our segment where we have to stress this is not financial advice. We are not advisors, but we do like to sketch out an outrageous but plausible trade idea based on the deep dive.
And today's idea is all about timing. It's about leveraging two key events that management has put a date on: the full ramp-up of the recurring model and that big margin boost from the MilliporeSigma deal in the second half of 26.
The market isn't fully pricing that in yet, you think?
I don't think so.
Yeah.
It's still being valued, to some extent, like a low-margin hardware company. The market sees the potential, but it's a show-me story.
So if the big payoff is, say, 18 months out, how would you structure a trade to capture that?
The pitch here is a long-dated, deep-in-the-money call option with an expiration out in early 2027.
Why an option instead of just buying the stock?
It's for capital efficiency and to ride out the short-term bumps. There will be volatility quarter to quarter. An option with a long expiration lets you look past that noise and focus on the big strategic payoff.
And why early 2027 specifically?
Because by then, the thesis will have either played out or it won't have. The consumables from that record order will be flowing at full speed. And more importantly, the cost savings from the MilliporeSigma deal will have shown up in the financials for 2 full quarters.
So by then, the proof will be in the numbers.
Exactly. If they execute, the company's financial profile will look completely different, and the market will be forced to re-rate it from a hardware vendor to a high-margin, recurring revenue platform company. That's the trade.
A really interesting thought experiment, perfectly timed to the story they're telling.
It comes down to H2 2026.
All right, so to wrap up this deep dive, the 2 big takeaways. First, that record order is the proof point. It validates their value proposition for the biggest players in pharma.
And second, that 62% recurring revenue base, which is growing fast, fundamentally de-risks the business model and gives them that high visibility cash flow.
The structural pieces, the reduced cash burn, the liquidity, the partnerships, they seem to be in place.
They are.
But here is the final provocative thought we want to leave you with. The success of this quarter's narrative, this whole story, it all hinges on the next 18 months. How smoothly can they install, validate, and ramp up the consumables for that massive global order? How quickly can they turn those system placements into the durable, high-margin revenue they've promised for the second half of 2026?
That one metric is what will ultimately determine the long-term value here. The next 4 quarters are all about quiet, disciplined execution.
Thanks for diving deep with us. We'll catch you on the next call.